Are you a small business owner, self-employed, or you earn your income with a 1099 or a K1? You are then one of the lucky ones. Being your own boss allows you to choose which 18 hours of the day you are going to work. The Small Business Administration reported that small businesses, less than 500 employees, create some 64% of all the new jobs in the US. When it comes to small business job creation, I like to ponder the words of Winston Churchill. Never in the field of human conflict was so much owed by so many to so few. In this case, so much is owed to small business owners. Unfortunately, when it comes to getting a mortgage from financial institutions, the expected gratitude for creating all those jobs does not appear to be self-evident. Fortunately, in today's mortgage arena, this apparent ingratitude is somewhat misleading. Self-employed individuals may well qualify for a conventional mortgage at the same interest rates as their W-2 earning fellow citizens. But if not, there are mortgage opportunities for the remainder of self-employed individuals who fail to qualify for a conventional mortgage. As a small business owner or self-employed earner, you have two distinct options for your mortgage. These come with different requirements and limitations. Conventional or qualified mortgages available to self-employed are mortgages that are sold to the government-sponsored organizations Fannie Mae or Freddie Mac, or insured through the FHA, VA, or USDA. To qualify, your income calculations is mostly based on your tax returns. Qualifying for such a loan requires more paperwork, but comes with the same interest rate as the popular conventional mortgages. The amount of the loan is also subject to limitations. Portfolio loans or non-qualified mortgages are loans that are held by financial institutions such as banks, pension funds, or hedge funds. The income calculation for these loans are essentially based on cash flow generated over a period of 12 or 24 months. They are known as bank statement loans. Interest rates are higher than the conventional or qualified mortgages, but the paperwork could be less and there are little limitations on the size of the loan. In deciding which category, qualified or non-qualified, is best suited for you, your desired loan size, and whether your tax returns demonstrate sufficient income to qualify for your desired loan will be the determining factor. The federal tax code gives the self-employed the right to deduct business-related expenses from their income before calculating the tax owed. Don't be fooled. This is not a sign of a kinder and gentler government. By giving these breaks, they know that more risk will be taken in developing small businesses, more employees will be hired, more money will be infused into the economy through vendors and suppliers, and guess what? More taxes will be generated. Every year when tax season arrives, the self-employed, in the words of Dave Berry, gather up those receipts, get out those tax forms, sharpen up that pencil and stab yourself in the aorta, and then you go and see the accountant. The accountant looks at your receipts and in a soft, comforting voice admires your creative deductions and promises to write to you regularly when you are in prison. Then a stern voice, he tells you, "Now do not make me use my accountant voice." At the end, you normally receive enough deductions to reduce your tax bill, but at the same time move you out of the conventional mortgage bucket. Don't worry, all is not lost. You are now able to buy that great expensive home. No mortgage size limitations, even if you have to pay a higher interest rate. But in the infomercial language, wait, there is more. What is the actual difference in my monthly payment between a conventional and a non-conventional loan? To get an idea of that difference, let's walk through a hypothetical example based purely on the principal and interest rate payments only. On a conventional mortgage of $800,000, fixed for 30 years at 4% interest rate, the monthly principal and interest payment would be $3,819. On a non-conventional mortgage of the same amount, also fixed for 30 years, but at a 5.5% interest rate, the monthly principal and interest payment would be $4,542. The difference is $723. Now ask yourself, by being a self-employed, is your savings related to tax deductions greater than $723 per month? These non-conventional loans are also available for second homes, investment properties, and if you need capital for your business, don't forget about the available cash-out refi options. Strike now while the iron is hot. In the Show More section below this video, you will find our web address that will allow you to get pre-qualified or start your online application to get the ball rolling. Please like this video and subscribe to our channel for more mortgage tips and, dare I say, more tricks of the trade. Thank you.